Hey everyone, welcome to Professor FinTech. Quick question. Have you ever wondered how big companies like Amazon or Tesla keep track of millions of transactions every single day? Or how your favorite local cafe knows exactly how much money they made last month? The answer is journal entries. And by the end of this video, you will know exactly how to create them like a pro, even if you are never studied accounting before. Today we are diving deep into journal entries, the foundation of accounting. Trust me, this is easier than you think, and I'm going to explain it using real life examples that actually make sense. Before we start, smash that like button if you are ready to learn something new today and hit subscribe so you don't miss our upcoming accounting tutorials. Alright, let's get into it. So imagine this scenario with me. You wake up one morning and you check your phone. You see a notification $5,000 debited from your account. But wait, you have no idea what you spent that money on. Was it groceries? That online course you wanted? Or did someone hack your account? Frustrating, right? Now imagine running a business without keeping track of where money comes from and where it goes. That would be complete chaos. That's exactly why journal entries exist. Think of them as the diary of your business. Every single transaction, whether you are buying supplies, paying rent, or receiving money from customers, gets recorded in a journal entries. Here, what makes them special, they capture the story behind every transaction. They are the foundation of all financial reports. Without them, you literally cannot prepare accurate financial statements. They help you track very where every rupee goes. When I first started learning accounting, I thought journal entries were complicated, but once I understood the logic behind them, it became like solving a puzzle and honestly pretty fun. What is a journal entry? So, what exactly is a journal entry? In the simplest terms possible, a journal entry is just a formal way of recording a business transaction. That's it. Every journal entry has these things: the date, when did this happen, the accounts, which parts of the business are affected, the amounts, how much money are we talking about, a narration, a brief description explaining what happened. Now here's the most important concept you need to understand. Every journal entry has two sides. Think of it like Newton's third law. Remember from physics, every action has an equal and opposite reaction. In accounting, we call this the dual aspect concept. When something comes into your business, we call that a debit. When something goes out of your business, we call that a credit. And here's the golden rule that never changes. In every journal entry, your total debits must always equal your total credits. Always, no exceptions. Think of it like a seesaw on a playground. For the seesaw to be balanced, both sides need equal weight. If one side is heavier, it tips over. Same with journal entries. If debits don't equal credits, your books are out of balance. All right, now that you understand the why behind journal entries, let's break down the how. What are the actual components of a journal entry? Let's dive into the four essential elements. Every journal entry has four key components. Let me walk you through each one. Date. First, you write the date of the transaction. This seems obvious, but it's crucial. You need to know when money moved so you can track your finances over the time. Second, accounts. You identify which accounts are affected. Remember, every transaction touches at least two accounts. That's the dual aspect we talked about. Third, amounts. You write the amounts, how much money is involved, and you will write it twice, once for the debit side and once for the credit side. And remember, these amounts must be equal. Finally, narration. You write a brief narration or description. This is like adding a caption to a photo. It explains what the transaction was about. So anyone reading your books later can understand what happened. So to summarize, date, accounts, amounts, and narration. Got it? Let's see what this looks like in practice. Let me share. let me show you real example that you can relate to. Imagine you are running a small business. You need to buy office supplies, pens, papers, staplers, all that stuff. You go to stationery shop and spend $5,000 in cash. Here's how we would record this transaction. First, we write the date, February 16, 2026. Next, we write office supplies account debit. That means debit $5,000. Then on the next line, slightly indented, we write to cash account credit. That means credit $5,000. And finally, in parentheses, we write the narration being office supplies purchased for cash. Let's break down why we did it this way. We debited office supplies because we got something. We now own these supplies. Our assets increased. We credited cash because we gave cash. Our cash decreased. Now notice how the credit entry is indented. That's the standard format. The debit account always comes first and the credit account is always indented below it. This makes it super easy to read. See, not so scary, right? Once you understand the logic, it's just like a following a recipe. Now I know that you are thinking, okay, but how do I know which accounts to debit and which to credit? Great question. And this is where the magic happens. I'm about to teach you a memory trick that will make your life so much easier. It's called the DEALER method. And trust me, once you learn this, you will never forget it. DEALER is a simple way to remember which accounts get debited and which gets credited. Let me break it down for you. Left side, you can see DEA, debit side, right? And the right side, LER, credit side. DEA stands for drawings when the owner takes money out. E stands for expenses, cost the business pays. A stands for assets, things the business owns. These three types of accounts are on the debit side. The L stands for liabilities, money the business owes. E stands for equity, owner's investment in the business. R stands for revenue, income the business earns. These three types of accounts are on the credit side. Here's how I remember it. Think of DEA as deal. When you deal with money going out or resources coming in, you debit it. And area stands for like layer. When you are creating obligation or learning money, you credit. Or think of this way. DEA accounts are things you own or spend. LER accounts are things you owe or earn. So let's say you buy a laptop for your business. Laptop is an asset, so it's in DEA. When asset increases, we debit them. Some simple. Or let's say you make a sale, earn $10,000. Sales is a revenue, which is in area. When revenue increases, we credit it. Easy. Let's go deeper into the DEA side. Drawings, expenses, and assets. Drawings, when the owner withdraws money from the business for personal use, we debit drawings. Why? Because the business is giving something away. It's like an expense for the owner's personal needs. Expenses. When you pay rent, salaries, electricity bills, or any business cost, you debit the expense account. Think of it this way. Expenses are money leaving your business, and we record that by debiting. Assets. When you buy equipment, furniture, inventory, or receive cash, you debit the asset account. Why? Because your business now owns something new. Here's the pattern. DEA accounts increases with the debits, decreases with the credits. So if you buy a car, asset increases, debit car account. If you sell a car, assets decreases, credit car account. Just remember, DEA loves debits. When DEA accounts go up, debit them. Now let's look at the other side, LER, liabilities, equity and revenue. Liabilities, when you borrow money from a bank or buy goods on a credit, you credit the liability account. Why? Because you now owe someone money. You have an obligation. Equity, when the owner invests money into the business or when profits are added to capital, you credit equity. This represents the owner's stake in the business. Revenue, when you make sales or earn income from services, you credit revenue. This is money coming into your business. The pattern here is opposite. LER accounts increases with the credits and decreases with the debits. So if you take a loan, liability increases. Credit loan account. If you repay a loan, liability decreases. Debit loan account. Remember, LER loves credits. When LER accounts go up, credit them. Once you memorize DEA, LER, journal entries become super logical. You will know immediately which side every account goes on. Let's see this quiz. Alright. This is where you get to test your understanding. Here's the scenario. You purchase a laptop for your business worth 50,000 and you pay in cash. Which accounts are affected? What do you debit and credit? Think about it for a moment. Pause the video if you need to. Got your answer? Let's see. The correct answer is debit laptop account. It's an asset, DEA. Credit cash account, also an asset, DEA, but it's decreasing. Both laptop and cash are assets. When we get the laptop, we debit it because assets increase with the debits. When we pay cash, we credit it because that asset is decreasing. Did you get it right? Drop a yes in the comments. If you got it wrong, no worries. That's how we learn. Keep watching. Okay, now comes the fun part, real life examples. I'm going to walk you through 5 different scenarios that you will actually encounter in your real business. By the end of these examples, you will be creating journal entries in your sleep. Let's go. Example 1, purchasing furniture. Let's say you are setting up a new office and you need to buy furniture, desk, chairs, cabinets. You go to a furniture store and buy $25,000 worth of a furniture, paying in cash. How do you record that? First, identify the accounts. We bought furniture, it's an asset, and we paid cash, also an asset. Apply DEA LER rule, both are assets, so they are in the DEA. Determine debit and credit. Furniture is increasing, so we debit it. Cash is decreasing, so we credit it. Here's the journal entry. Furniture account debit 25,000, cash account credit $25,000. Being furniture purchased for cash. See how it makes sense? We got furniture debit and we gave cash credit. The dual aspect is balanced. Both sides are $25,000. Example 2, buying supplies on credit. Now let's say you run a retail store and you need to buy inventory from a supplier called ABC Traders. You purchase goods worth $80,000, but you don't pay immediately. You buy on a credit, meaning you will pay later. How do we record this? Step 1, accounts involved. We are buying purchases, inventory or expense, and we are creating a payable to ABC Traders, liability. Apply DEA LER. Purchase is an expense, DEA. ABC Trader is a liability, LER. Determine debit or credit. Purchase is increasing, debit. Liability to ABC Trader is increasing, credit. Here's the entry. Purchase account debit $80,000 to ABC Traders account credit $80,000, being goods purchased on credit from ABC Traders. Notice something important here. We didn't use cash out all. This is a credit transaction. We will pay ABC Traders later. So we create a liability. We owe them money. Example 3, receiving cash from a customer. Let's say you run a consulting business and you provide a service to client. After completing the work, the client pays you $15,000 in cash. What's the journal entry? First, we have to identify accounts. We are receiving cash, it's assets, and we are earning service revenue. DEA LER rule now. Cash is a DEA, service revenue is in a LER. Now identify debit or credit. Cash is increasing, so debit, revenue is increasing, credit. The entry, cash account debit $15,000 to service revenue account $15,000, being cash received for services provided. This is a classic revenue transaction. Money comes in, debit cash. We recognize income, credit revenue. This is how business track their earnings. Example 4, paying employee salary. It's the end of the month and you need to pay your employees their salaries. Let's say the total is $50,000 and you pay in cash. How do we record this? First, accounts that we need to identify. We are paying salary, it's an expenses account. We are giving cash. Cash is an asset. Now DEA LER rule. Salary expenses is in the DEA. Cash is also in DEA. Debit and credit rule. Salary expenses is increasing. We are incurring cost. Debit. Cash is decreasing. That's credit. The entry. Salary expense account debit 50,000 to cash account credit 50,000, being salaries paid to employees. This is probably one of the most common entries businesses make every month. Expenses goes up, debit. Cash goes down, credit. Simple as that. Example 5, owner brings capital. Let's say you are starting a new business and you invest $100,000 of your own money into company as a startup capital. How would we record this? First, we have to identify accounts. We are receiving cash. Cash is assets. And we are creating capital. Capital is equity. Now, second, DEA LER rule. Cash is in DEA, capital is in LER, is the owner's equity. Debit and credit rule. Cash is increasing, so debit. Capital is also increasing, it's a credit. The entry. Cash account debit $100,000 to capital account $100,000. Being capital introduced by owner. This entry shows the owner's investment in the business. The business now has $100,000 in cash asset and it owes that to the owner in the form of equity capital. This is how business gets started. Time for quiz. Sinar, you pay $10,000 rent for your office space. What's the correct journal entry? Think about it. Pause if you need to. Answer is debit rent expense account credit cash. Why? Rent is an expense, DEA, and it's increasing, so we debit it. Cash is an asset, DEA, and it's decreasing, so we credit it. Comment below if you got this one right. And if you are finding this helpful, share this video with someone who is learning accounting too. Alright, before we wrap up, let me share some common mistakes that beginners make. So you don't think of a debit as bad and credit as good. In everyday life, when your bank account is debited, you lose money. So debit feels negative. But in accounting, debit and credit are just left and right. They are neutral terms. Don't forget to indent the credit account. I know it seems like a small thing, but proper formatting makes your work look professional and easy to read. Don't skip the narration. I have seen students write entries without explaining what the transaction was about. Always include a brief description. It helps anyone who reads your books later. Don't let your debits and credits be unequal. If they don't balance, something is wrong. Always double check your math. Don't use the wrong account type. You are buying a computer, it's an asset, not an expense. Know your account categories. The good news is these mistakes are totally normal when you are learning. The more you practice, the fewer mistakes you will make. Key takeaways. Let's recap the 6 most important things you learned today. Every transaction affects at least 2 accounts. That's the dual aspect concept. It's fundamental. Second, total debit must always equal total credits. No exception. This is the golden rule of accounting. Use DEA LER to remember which accounts get debited, which gets credited. DEA loves debits, LER loves credits. DEA accounts, drawings, expenses, assets increase with debits and decrease with credits. LER accounts, liabilities, equity, revenue increase with credits, decrease with debits. Always include 4 components: date, accounts, amounts, and narration. Never skip any of these. If you understand these 6 points, you already got a solid foundation in journal entries. Give yourself a pat on the back. Your action stays. Now, here's what you should do next to master journal entries. Practice 5 to 10 journal entries every single day. Start with simple cash transactions, buying supplies, paying bills, receiving payments. Gradually move to more complex entries: credit purchase, loan transaction, depreciation. Challenge yourself. Use accounting practice apps or websites. These are tons of free resources online where you can practice. Join study group or online forums. Learning with others makes it more fun and you can help each other out. Watch more videos on our channel. We are going to cover ledgers, trial balances, financial statements, the whole accounting cycle. And most importantly, don't be afraid to make mistakes. Mistakes are how we learn. I made tons of errors when I was learning, and that's completely okay. If you have any questions about journal entries, drop them in the comments below. I read every single comment and I will answer your questions.